Hello again, and welcome to our third and final segment on the possible implications of rent control in the city of Seattle. Now that I'm wrapping up the series, I imagine that many of you, if not most of you, are as shocked as I am by the implications of what we as landlords have already lost. I believe that the risk to owners of apartment buildings in the city of Seattle has greatly increased, and there are currently ways that are significantly profitable to adjust your portfolio to avoid those losses altogether and simply not participate in them. Today we'll be discussing actions that you can take now that will protect you, yourself, your families, and your wealth if rent control is imposed in the city of Seattle. As I've been preparing for this series, it's dawned on me that rent control in the city of Seattle could be the equivalent of a 2008 event for investors. It's important that we look at our options now and make changes while we have the ability to do so. First, I want to say that if you have the ability to accept static or greatly reduced asset value and rent for an extended period of time, you'll likely be just fine even if rent control is imposed. In my mind, there's no doubt apartment owners will suffer a significant loss in equity and income, but if you hold on long enough, the values will come back. The question is, do you want to participate in that, or would you rather invest in other areas and then come back and take that equity that's grown as opposed to lost or remain static and reinvest it after the market recovers? I know that would be my choice, and I imagine that would be the choice for many of you as well. The simple solution is to buy apartment buildings outside the city of Seattle. Now, I know that many of you are shocked to hear me say this. I'm shocked to be saying it myself. My big takeaway from 2008 was that when things change, deal with it. Change with the reality and don't just continue with the same actions. Simply buying outside areas that don't have rent control as a likely reality in the near term will very much protect our assets and our equity and our income. Currently, there is still a very strong appetite for apartment buildings in the city of Seattle. The thing is that owners now have the ability to sell before the storm comes. This would give you the ability to move your assets to areas outside the city of Seattle. For example, in a 1031 tax-deferred exchange, and weather the storm outside the city and be able to come back after things have settled and calmed down. As I said, this is something that could very likely be a decade plus or minus event. As I mentioned in the beginning of this series, I intended to give you some ideas on what our clients are currently doing to protect themselves and what kind of impact it's had on themselves and their portfolios. One of our clients simply decided to take their equity, sell their building in the city of Seattle, and invest outside of the city. They looked at two separate options. Option A was a list of conforming properties, in other words, 4 units or less, up and down the I-5 corridor. Now, this takes us out of the old model of staying in the middle of the best neighborhood we can afford, but it diversifies in a significant way because the equity in one building that they had in Seattle gave them the ability to buy 4 to 5 properties and have them professionally managed and still have positive cash flow. The impact of quadrupling the number of units that they had outweighed the reduction in likely appreciation. The second scenario that they looked at was simply buying a much larger building outside the city of Seattle. This happened to be what they chose to do in the end. And bottom line is they sold a 4-unit building in the city of Seattle and bought a 23-unit building just outside the city of Seattle. This increased their number of units from 4 to 23, which does a lot of things. Number one, it greatly reduces your risk. If you have one vacancy in 23, that's much less risk than having one vacancy in 4. The other thing it did is it greatly increased their cash flow. Their 4-unit building in the city of Seattle, although it appreciated really well, the cash flow was something in the neighborhood of $10,000 to $15,000 a year on the positive side. The 23-unit outside the city of Seattle was between $70,000 and $100,000 a year in positive cash flow. That's a pretty significant difference that greatly reduces risk. The next thing that this accomplished for them is it enabled them to realign their loan-to-value ratio. The property that they owned in Seattle, they had more than 50% equity in because of the increase in value. The 23 unit, they were able to get back to 25% equity or 75% loan to value. In other words, less of their own money was invested, which gives them a higher return. Again, I'm sure you all recall this, but if we invest $1 and make $1, we have a 100% return. But if we invest 25 cents and make $1, we have a 400% return. The bottom line is, as apartment owners, we always need to manage our loan to value ratios. When all is said and done, at the end of the day, these clients were able to lower their risk and very likely meet or exceed their appreciation potential inside the city of Seattle with a very unlikely potential of rent control anytime in the near future. When we look at things like increasing the number of units owned in such a dramatic way from some, say, 4 to 23, it enables us to duplicate the appreciation potential in the core areas if we pay attention to all of the details. For example, raising the rent by $100 a month in 23 units is $2,300 a month. Now we might have a gross rent multiplier that's a 13 as opposed to a 17 or an 18, but the bottom line is that it's much more challenging to raise the rents by $2,300 a month in 4 units than it is in 23. I want to go back to the fact that owning apartment buildings in the city of Seattle has been a great thing for many, many years, and I believe it will continue to be a great thing for generations to come. The issue is that we simply have a period of time, which I think will probably last something in the neighborhood of a decade, where there is a significant risk. I'm not suggesting a course of action. What I'm suggesting is that we take the time to sit down and analyze your options and look at what you can do to protect yourself, your family, and your investments as efficiently and profitably as possible. I appreciate you joining me, and I look forward to talking to you again about another interesting topic in the very near future. So, I strongly encourage you to set up a portfolio review so we can sit down and take a look at your personal situation and look at what your best course of action is. Simply email Betsy and she can go ahead and set up a meeting at either our Kirkland location or our Bellevue location at a time that's convenient for you, and we can look at what your best options are.